Imagine a time when paper money was literally worth less than kindling. In 1923 Weimar Germany, marks lost so much value that families burned banknotes to heat their homes. Fast forward to Zimbabwe 2008, during one of history's wildest money meltdowns. Hyperinflation there reached an estimated 79.6 billion% per month at its peak. A $100 trillion Zimbabwe bill couldn't even buy a bus fare. People used these massive denomination notes as wallpaper or toilet paper, anything but currency. This extreme scenario was hyperinflation, runaway prices eating away money's value. But today's concern is stagflation, a very different beast. Instead of money collapsing overnight, stagflation means high inflation plus stagnating growth and rising unemployment at the same time. It's the worst of both worlds. Prices keep climbing, yet the economy is flat or sinking. Economist Jerome Powell recently warned that policies causing higher inflation and slower growth can create the classic ingredients of stagflation. In other words, inflation without a booming economy. This is precisely what shocked experts in the 1970s, and now the ghost of stagflation is haunting markets again. What is stagflation? While hyperinflation is too much money chasing too few goods, stagflation is sticky inflation in a weak economy. Stagflation's name comes from stagnation plus inflation. As the Federal Reserve history notes, in normal times, inflation and growth have an inverse trade-off, the Phillips curve. But stagflation defies that rule. Instead of prosperity with rising prices or recessions with falling prices, stagflation is rising prices with slow growth and high unemployment. One financial analyst put it bluntly: stagflation has definitely re-emerged as a possibility. In stagflation, consumers feel squeezed. You pay more for groceries and gasoline. But the job market is weak and paychecks aren't rising. Stagflation in the 1970s. The original case study. In the 1970s, the US was hit by stagflation, a toxic mix of high inflation and stagnant growth. It began with soaring budget deficits, the collapse of the gold standard, and two major oil shocks, the 1973 OPEC embargo and the 1979 Iranian Revolution, which sent oil prices soaring. Gas lines formed and energy costs surged across the economy. This triggered a wage price spiral. Workers demanded higher wages to keep up, and businesses raised prices in response. The result? Stubborn inflation that persisted through multiple recessions and a stalled economy. By late 1979, annual inflation was in double digits and unemployment was back above 6%. It took a dramatic shift to break the cycle. Paul Volcker, appointed Fed chairman in 1979, fought inflation by driving interest rates into the stratosphere. The prime rate climbed above 21%. The Fed engineered two sharp recessions, 1980 and 1981, 82, to crush demand. Unemployment peaked near 11% by 1982. Yes, the pain was deep, but it worked. Inflation eventually fell back toward the Fed's 2% goal, teaching a harsh lesson that stubborn inflation might require very high rates and even short-term job losses to defeat. The economy after 2022, echoes of the past. Today, the US is emerging from a post-pandemic economic roller coaster. Between 2021 and 2022, massive spending and supply chain issues pushed inflation from 2% to over 9%. In response, the Fed aggressively raised interest rates from near zero to 5.25%. By mid-2023, the highest in 20 years, borrowing costs soared across the board from mortgages to business loans. While inflation has dropped to around 3.3% by mid-2024, it's still above the Fed's 2% target. Growth is sluggish, job gains have slowed, and borrowing remains difficult. Experts warn this mix, lingering inflation, high rates, and weak growth, mirrors the conditions that fueled 1970s-style stagflation. Consumer confidence is low and inflation expectations remain elevated, with many Americans still bracing for rising prices. Why experts are warning of stagflation. Experts and policymakers are sounding the alarm. Reuters reports that stubborn inflation and renewed trade tensions have revived fears of stagflation. Proposed tariffs could slow growth while pushing prices even higher. Strategist Jack McIntyre warns that current policies risk hurting demand while tying the Fed's hands. Even the Fed acknowledges the threat. In May 2025, officials noted the risk of rising inflation alongside a weakening job market. Classic stagflation. Economist Tim Urbanowitz says it plainly. Stagflation is the bigger concern. Now the Fed faces a tightrope. Lower rates too soon and inflation may spike again. Keep them high and growth could stall. With the 1970s in mind, the stakes are clear. Missteps could come at a heavy cost. The psychology of inflation. The self-fulfilling prophecy. It's not just the numbers that matter, but what people believe will happen. Economists talk about inflation expectations and confidence. If businesses and consumers start to expect higher prices for months ahead, their actions can make it real. This inflationary psychology is a kind of self-fulfilling prophecy. For example, if shoppers rush to buy now before anticipated price hikes, that extra demand fuels even more price rises. If workers demand big pay raises because they foresee runaway inflation, employers may raise prices further to cover costs. Recent surveys suggest Americans are on edge. In early 2025, consumer confidence hit a 4-year low as trade tensions grew. Meanwhile, average US households began to expect much higher inflation, around 5.1% over the next year. That's double the Fed's goal. Such shifts in expectations can drive actual inflation higher, or at least keep it from falling, which in turn can undermine spending and investment decisions. In short, nervous consumers and businesses might cut back or behave cautiously, slowing growth while prices keep climbing. That behavioral feedback loop is what makes stagflation so tricky. Lessons from the past. The good news? History offers clear lessons. In the 1970s, price controls and tariffs only worsened inflation by creating shortages. The takeaway? Artificial fixes often backfire. Transparent, market-driven policies work better. Volcker's painful rate hikes also showed that anchoring inflation expectations is key. Today's Fed knows public trust in stable prices is essential to prevent even moderate inflation from spiraling. Trade and fiscal policy matter too. The IMF warns that tariffs and rising deficits could stall growth. Cooperation and discipline are crucial in a global economy. The message is clear. Stagflation is preventable, but only if we act early, stay disciplined, and learn from past mistakes. The stakes are high and complacency is the real danger.